So we'll continue with the liquidity ratio. So current ratio can be expressed as current asset minus divided by current liabilities. So the ratio is ideally, it has to be in an ideal format of 2:1. That is the ideal ratio. And current ratio tells us whether the company has enough amount of liquid assets. Okay, so assets that can be converted into cash within a year, that is called as current assets. Okay, so current assets can be like stock or debtors, receivable, cash equivalents, short-term investments, like that. So these are things which can be converted into cash within a short period of time. Short period of time is 1 year. So sometimes a company might also set aside a fixed asset, okay, which is to be sold within a 1 year. So will that fixed asset become a part of the current asset? The answer is yes. So any asset, even a fixed asset, which is going to be sold within a 1 year time, that can be classified as a current asset also. So what is a current liability? So any liability that is going to be settled within a year's time is a current liability. So bank overdraft, creditors, payables, these become current liabilities here. See, sometimes even a long-term liability can become a current liability. For example, assume that you have a long-term loan. This long-term loan is to be paid in the next 1 year. Okay, so it's a we'll put it like the 5-year bond. Okay, so 4 years have already gone, and this is the last year. So in the last year, the 5-year bond will become a current liability because it is expected to be paid in the next 1 year. Okay, so even fixed assets can become a current asset, and the long-term liability can also become a current liability. So however it is, the company should have a ratio of 2:1. Okay, see, 2:1 is a general or ideal ratio, but it depends upon the industry level. So in the industry, whatever the average is, that average only we have to take as the ideal. Okay, so it is expressed in terms of a ratio, right? It is not a percentage number, it is a ratio. So this one is, we can't say it is higher the better, it should be around the industry average, right? It should be around the industry average. So that is the ideal thing here. So a company should have a decent amount of current ratio. Okay, if it's going to be very low, okay, it indicates liquidity strength okay, it indicates liquidity strength of a company. So what does quick ratio tell you? See, quick ratio is like very simple or very similar to the current ratio except for the quick asset. So quick asset here, it is nothing but the current asset minus the inventory. Okay, so why do we direct the inventory alone? Because see, inventory takes a little bit longer time to convert into an asset, okay, into cash. So other things like cash or receivables or prepaid amount or all, I think even prepaid you should not include. You should not include prepaid expense. Normally, prepaid expense is a current asset, but even that should not be included here. So these are not, see, prepaid expense is an already paid expense, so we remove that. And inventory cannot be like very quickly converted into cash, so that also we remove. So quick asset is an asset which is like much more quickly sold. Okay, even below a year we can quickly sell it off, or at least we can mortgage it, okay, quickly. So that's about the quick asset. The denominator current liability is the same. There's not going to be much of a change. So again, the concept is going to be whatever is for current ratio, the same will be here, except for the ideal. The ideal would be 1:1. Okay, the ideal is 1:1 ratio. Okay, so now we'll move on to the next ratio, which is called as the activity ratios. So activity analysis tells us how effectively a company uses its assets. Okay, so we have different ratios like inventory ratio, receivables ratio, payables ratio, asset turnover ratio, fixed asset turnover, and working capital turnover. Okay, so if you look at all these ratios, okay, there's like one common thing here. The denominator will have the ratio's name. Okay, for example, if you take inventory turnover ratio, the ratio is divided by inventory. In receivables turnover ratio, it's the ratio is divided by average receivables or average debtors. Payables turnover ratio, it's divided by the payables or creditors. If you take asset turnover ratio, denominator is asset. In fixed asset turnover ratio, denominator is fixed asset. In working capital turnover ratio, the denominator is working capital. So if you see, throughout all these ratios, the denominator is the ratio's name. Okay, so how is the numerator there? See, numerator alone, like there are only three numerators available. So one is cost of goods sold or credit sales, okay, credit purchase and sales. That's it. Okay, so for inventory turnover, it is cost of goods sold divided by average inventory. What does this ratio indicate? Okay, see, when compared to this ratio, it is better that you express this ratio in terms of a inventory days. Okay, so first you find out inventory turnover ratio, then for inventory days it is equals to 365 divided by inventory turnover ratio. This will express a number in days. Okay, the inventory days will express a answer in days. Okay, so the lower the better. Why is lower the better? Because it indicates the number of days the inventory is held by the company. So we can put it like this. So the shorter the inventory days, the better it is for the company. So the next one is receivables turnover ratio. So the formula is credit sales divided by average debtors. Okay, and receivable days equals to 365 divided by the previous answer. Okay, receivables turnover ratio. Again, this is also like expressed in days, and this also is the lower is the better. Okay, so what does it indicate? It indicates the time taken by credit customers to repay the amount. Okay, so it indicates that the credit customers, they buy the goods from us and when they are going to pay it. Okay, so the lower it is, the better. So the next one is payables turnover ratio, where the formula is credit purchase divided by average creditors, and payable days equals to 365 days divided by payables turnover. Okay, so this ratio also is indicated by days, and here the higher is better. So why it is like that? See, it indicates the days we take to pay our suppliers. Okay, so we would have bought goods on credit purchase, and how many days we take. So the more the delay we could make, the better is for the company, right? So the how much ever we could delay, it's better actually for the company. See, so this forms a good idea here, but the problem is you should not be like taking too much of time. There's a limit to how much of days you can extend. If you extend it beyond a limit, they will stop giving you the goods. Okay, and finally you have to suffer uh, without production. Okay, without raw materials you will suffer, and you can't produce at all. Okay, so there is a limit to how much all these things can be. Okay, but the limit has to be set only by the industry average. So we can't say whether it is lower is better or higher is better like that, but we can't say what is the average, what is the meaning of higher. Okay, is it like 10 days, 100 days, 300 days? What is higher, we don't know. Okay, that would be like set only by the industry average. Okay, so the next one is cash conversion cycle. So here what you do, you compute the whatever you computed here as the days, those days you put it here, you add both the inventory days, okay, the days your money is stuck in the as inventory and as credit per sales, and you reduce the days it has, and you reduce the days the supplier's money that is locked with you. Okay, so that's about the idea here. So the next one is asset turnover ratio. In asset turnover ratio, see again it is just a ratio here. Okay, we can't say it is ratio, we can put it as times. Okay, we refer it to as times. Okay, so for example the number would be 100 divided by 10, it is 10 times. Okay, so what is this times refer to? See, this tells us the efficiency of the how efficiently we use the asset when compared to the sales. Are we able to generate more sales with the asset? Okay, so if a company has an asset turnover ratio of 10, okay, A company has 10 and B company has 30, then 30 is a much efficient company because they are able to generate for every 1 rupee of asset 30 rupee of sale. Okay, it's like that. For every 1 rupee of asset, how many rupee of sales the company is able to generate. Okay, so if you take some companies like IT companies, their asset is lower but their sales is higher, so they have a high asset turnover ratio. If you take a manufacturing company, they have high assets and equivalent sales, so they have a somewhat equal kind of a sales asset turnover ratio. It would be like around 1 or something. So here it is very clearly the higher the better. Okay, so it is going to indicates the efficient usage of the total asset, right? So the same concept works with fixed asset also. How well the company is using the fixed asset, so without taking the current asset, how well it is using it. And the last one is in terms of the working capital, how much efficiently they are using the working capital. So almost all the three ratios are similar only, so we can take the same concept and we can type it here. So if you take in fixed asset turnover ratio, it's about the how well the company is efficiently using its fixed asset. In working capital turnover ratio, how well it is using its working capital. Okay, so that's about the concept here, and that's about the activity ratios. So let's go to the solvency ratios, which is the last part of our analysis. So if you see here, debt equity ratio refers to long-term debt divided by equity shareholders funds. Okay, how much of money is invested by the external people and how much of money is invested by the internal people. Okay, so the ratio should be around 1:1. 1:1. Okay, and whether the higher is better or lower is better, okay, it should be around industry average. We can't say higher better, lower better, it should be around the industry average. Okay, so how is it expressed? Again, it is going to be expressed in terms of times. Okay, so it's 1 times or 2 times or like that, or 1.5 times like that. So it tells us, it indicates the capital contributed by different stakeholders. Okay, it's not shareholders, it is stakeholders. So we'll move on to the next one. The next one is interest coverage ratio. So interest coverage ratio is about whether the company has sufficient operating profit to pay the interest. Okay, so this ratio is again referred to in terms of times, right? And whether it's higher or lower, so it should be around the industry average. And usually it is we can say that the ideal, okay, the ideal is to be 8 times or something. Okay, ideal is 8 times. So what this ratio indicates is it indicates if the company, or not if, we can put Okay, if the company has sufficient profit to pay the interest on loan. Okay, so that's what it indicates. So the last ratio that we have here is dividend cover. So dividend coverage is very similar to the interest coverage ratio, but the only difference is here we are trying to find out whether the company has enough profits to pay dividend. Okay, so again this also is expressed in times, and it should be around the industry average. So we do not have any ideal or anything, but it indicates this. It indicates if the company has sufficient profit to pay equity dividend, right? So that's about the ratios. We have seen the theory for all these ratios. So what we'll do is we'll start with the problems. So we have a problem here. I have got all the ratios here itself, okay, so that we could work out it easily. So in this problem, we'll start from the required. So this problem has not been asked in any exam or anything. It's from a book. So the question requires you calculate the following accounting ratios for the year: gross profit, operating profit, ROCE, asset turnover, current ratio, inventory days, receivable days, payable days, and gearing. Okay, so this is what it asks. So what we'll do, we'll, as and when we are going to do the sum, okay, whichever ratio is like applicable, we do it. Whichever is not applicable, we'll delete it and we'll move on. Okay, so what we'll do, we'll start from here. We'll start from gross profit, or else what we'll do, we'll first see which ratios we have to work out, so that we don't need to see the question again and again. Okay, gross profit we have to do, operating profit we have to do, net profit we don't have. So we have ROCE, then we have current ratio, we don't have liquid ratio. Then in activity ratio we have inventory days, receivable days, payable days, and asset turnover. So they require asset turnover, so we'll do that also. Then we have current ratio, I think we have already done it. Payables, gearing. Okay, so conversion also we leave it. We have gearing, so this is what gearing is. We do not have coverage ratios and all, so we'll remove that. So these are the only ratios that we have to compute. So we'll compute it and we could move on. Okay, so we'll start. We have to get the gross profit. Is gross profit available? Yes. So if you see here, the revenue minus cost of goods sold, that is gross profit. Okay, so if you are going to do any extra step, we will so gross profit equals to okay minus COGS minus any direct expense, right? So that means if you take gross profit, sales is 975 minus 510 is the cost of goods sold, okay. So gross profit comes to 465. I think we can compute here. So it is 465 divided by 975, okay, into 100. Let's get the answer. So answer is 47.6 and that's a percentage. Okay. So why didn't we take the overheads? See, overheads is an indirect expense, so we should not take indirect expenses here. Okay. So that's why we have not taken it. So next we'll move on to operating profit. So operating profit is not directly available. So what we could do is we can take the gross profit. From that we can deduct the indirect expenses. If we deduct, we will get the operating profit. So we'll find out that. So operating profit would be from gross profit. Gross profit is 465. From there we will minus the 384. So we will get the answer. So operating profit is 81. So 81 is the answer. So let's get the answer here. So we got 8.33 as the answer here. So from gross profit we deducted the overheads. Okay, so we got the answer as 81 and we have found out this. So let's go to the next one. So the question has asked for ROCE also, right? The question has asked for ROCE also. So we have computed the operating profit, so that won't be a problem. But capital employed we have to find out. So to find out capital employed, there are two ways. Find out the total assets, right? So the total assets here is 586 minus the current liabilities. Okay, current liabilities are all these three items. Okay, how do we know that these are the three items? See, it is tax accounts payable. Okay, income tax is also a current liability, and also dividend payable is a current liability. Interest bearing borrowings is a long term liability. Okay, so you can compute in two ways. So both ways we will compute so that you will get the idea. Okay, we'll compute it in both ways. So we'll find out in this manner. Total assets is 586 minus current liabilities is, we have a list itself, 82 plus 24 plus 20. All these things are current liabilities. So when we solve it, we get 460. So we can also find out it in terms of this formula. So we'll just try to find it out. So the other way to find out is, we'll find it out here. Equity capital. So equity capital is 140. So we have it here. Plus the, see, we have to, equity capital always refers to equity capital plus the reserve also. If we have any preference shares, we can add that, or we can add the long-term debt. This is a long-term debt. Okay, so interest bearing borrowings, so that would be long-term debt. So that is 250. So put together, so either way you compute, it will give you the same answer. See, however you do, it will give you the same answer, 460. Okay, either one of the method you can do, whichever is easiest you do it, you will get the answer. So let's get the answer here. Operating profit is 81 that we found out earlier, and 460 are capital employed. This should be expressed in a percentage. So our number would be 17%. Okay, So now we'll start with the liquidity ratio. So liquidity ratios, it's going to be current ratio. So we'll be looking at current asset by current liability. So first we'll get the current assets. So current asset is going to include the inventory, so 127, plus the trade receivables 108, and the cash. And current liabilities is going to include, I think we have already found out current liabilities here, so we'll take the number from there. So we got the current asset and current liability. We'll work out the formula. 238 divided by 126. So the answer is expressed is to 1. So that's a sum. It is 1.88 is to 1. That's about current ratio. Let's go to activity ratio. So the activity ratio requires these numbers. So we know what is the sales. Sales is 975 divided by total assets, total of all the assets. So total asset comes to 586. So the answer is in terms of times. Okay, so it is 1.6 times. So we'll start with inventory turnover ratio. So inventory turnover ratio requires cost of goods sold. So first we have to get that number. So cost of goods sold is directly there given. Okay, so for this sum it's like directly given. So we don't need to much worry about it. COGS is 510 divided by average inventory. So if there are 2 years given, then we have to take an average inventory. As there's a single year given, we can just take the inventory as given. Okay, so this will give us the answer in times. It's 4, and for this one it is going to be 365 divided by 4.015. So let's get the answer. So the answer is 90.9 days. So we'll go to the receivables. So in receivables we have credit sales, okay, but there is no credit sales is given. So what you can do is you can put a note, okay, assuming all sales to be credit sales. You can note it like that, and then we could do it. So sales is 975 divided by average debtors. So here if you see, we don't have the word debtors, but we have receivables, so that is 108. If the question gives you receivables as well as debtors, both the number, you have to add it. Okay, you shouldn't take an average, you should add it. In case there's a 2 years, okay, you have receivables for year 1 and year 2, you have to take an average of it. As we only have a single year, we can just take the full number here. So let's get the answer. So the answer comes to 40 days. So let's go to the payables. So in payables, if you see, there is credit purchase, but we do not have any credit purchase in this problem. So what we can do is we can make an assumption assuming all COGS T to be credit purchase. Okay, so COGS has been 510. Divided by average creditors. So creditors is payables. So we have trade accounts payables. Okay, so that would be the creditors. So we'll take 82 and we'll solve it. So the answer is 6.21. So the number of days is 58 days. Okay, so let's go to the solvency ratio. So the solvency ratio is long-term debt divided by equity shareholders funds. Okay, so we'll as we don't have space, we'll put it here. Long-term debt is this number 250 divided by shareholders funds is 210. This is 140 plus 70. So if you want, I will put 140 plus 70 so that you will get the answer. So this answer is represented as is to 1. So it is 1.19 is to 1. Okay, so we have done the sum fully. We have done all the ratios also. So if you require, we can cut down the numbers after decimal. We can try to cut it down. Okay, so that it will look neat. So that's about this problem. So when you get a problem in ratio analysis, first see like what are the formulas required. Then if it's going to be in Excel, it's quite easy. Or else what you do is you first solve one by one. Okay, here we had set the format and then we solved it. If you're solving it in a paper, solve the formulas one by one. Start with gross profit margin, finish it, then go to operating profit, finish it, then keep on moving. Okay, as this is Excel, I have already put all the ratios and I could move them easily. I can add a row, I can delete a row, I can add a column. So that is flexibility I have. But for writing a exam on a paper, it's quite difficult. So ensure you get adopted to it. Okay, so we'll move on to the next problem. So the next problem is a lengthy problem here. So we have balance sheet separately, trading account, profit and loss account separately, and we also have the answers here. Okay, answers are also given, and we are required to calculate these ratios. So operating profit ratio, ROC, net profit, current ratio, quick ratio, turnover ratio. Turnover ratio they have put, I think it should be asset turnover ratio. Only when we do it, we'll know that. And the period ratio days. Okay, we have to do it for I think turnover ratio and the period ratio in terms of days for inventory turnover, debtor turnover, working capital turnover, or fixed asset turnover. Okay, so they are asking 5 turnover ratios they are asking, then debit equity ratio and interest coverage ratio they are asking. Okay, so first we will set what are the various ratios they are asking. So it is operating profit, ROC. So this is not there. Okay, so we do not have gross profit ratio. EBITDA is not there. I think in current ratio both we have to do, right? In liquidity ratios we have current ratio, quick ratio. Here all the inventory, receivable, payables is there. Conversion is not there. Then working capital and fixed asset turnover ratio is asking this. And finally they are asking debit equity ratio and interest coverage ratio. Okay, so these are the ratios they are asking. So we will work out these ratios. So it is up to you whether if you want you can do the sum in terms of thousands. You can cut the last 30 and get the answer. Then also the ratio will be giving you the same answer. So if you don't require the cutting of zeros in thousands, if you don't want to calculate, you can calculate also the full value and you can get the answer. Okay, so we'll start from operating profit ratio. So let's see whether the company has operating profit ratio. The answer is no. Okay, the company does not have operating profit, so we only have to compute it. So we'll start. So if you take operating profit, it's going to be the gross profit 6800 minus the administration expense, right? Thereafter selling expense. Okay, and selling expense I have to deduct. So selling expense is 600. Okay, so there is another non-operating income is there. I think that in that box is blank. And interest, other non-operating expense, again see here as a non-operating expense. Interest is also a non-operating expense, so those will not come here. Okay, so we'll just have to find out this. So let's get the net profit ratio. So if you take net profit ratio, I think it's quite easy. So we can find it out directly. Okay, I think there's some mistake in the profit and loss. Okay, because it shows here 68 lakhs and finally it shows the 30 lakhs here. So that means 38 lakhs should be this amount, but it is like beyond that. It seems to be a lot more than that. Okay, it is like 36, 39, 39 and 80,000. Okay, 39 lakh 80,000 is there. So I think there should have been some kind of an operating non-operating income should have been there, but we don't need to worry about that. Whatever like given, we'll work it out. Okay, whatever is like given, we'll work it out and get a answer. Okay, so see, we are only trying to find out an answer. We are not trying to find out any analysis we are doing here. So let's, okay, what was the net profit? Net profit is, so we got the answer. Let's go for ROCE. So in ROCE, we know what is the operating profit. Operating profit is 3,200 divided by capital employed. So that is alone we have to find out. Capital employed, we have two formulas, so we can use whichever formula we want. I think we'll use the first formula itself. We'll get the total asset minus current liability. There is only one current liability here. So it is, okay, let's solve it. So we got 45% as an answer. So let's start with liquidity ratio. It is current asset by current liability. So let's take current assets. Current assets here seem to be the stock Okay, so it's going to be stock, debtors, and cash divided by creditors. Okay, so let's get the answer. So the answer would be in terms of is to 1. So let's get the quick assets. So in quick assets, you will not have the inventory alone. Okay, so inventory alone you can remove it. So thereafter you can get the answer. So this also should be in is to 1. So we got that also. So we have the activity ratios. So for activity ratios, we have to get a lot of numbers. So we'll start. So first we have to get COGS. COGS will be like equaling the GP, okay, the gross profit sales minus gross profit, where that would be so this is our COGS. So thereafter we can find out we have found out COGS. Inventory is quite easy to find out. That won't be a problem. Inventory is here. So it is 2960. Okay. So in terms of days, if we are going to compute, it would be 365 divided by 3.4444. So let's get the answer. Answer is 106 days. Then we'll move on to the receivables. In terms of receivables, if you take, it's going to be credit sales. So there is no credit sales here. So you have to make a note again, note which is saying assuming all sales to be credit sales. So we can get the sales. Sales is debtors. Debtors is again is available 1420. So here it would be 365 divided by 11.97. It comes to 30 days. The next one is payables turnover. So here if you see there is no credit purchase. So assuming all COGS to be credit purchase. Okay, we can't have any other number. So COGS we have computed earlier itself. So COGS is around where we got it. So here it is. So COGS is 10,200. Payables is going to be, creditors are 2,600. So we got our turnover. So we got the answer. It is 93 days. Okay. So we have almost got all the numbers. So let's see what are the things which are missing. So we'll find out the fixed asset turnover ratio. These are like quite easy. So our sales is 17,000 divided by fixed asset alone. So fixed asset alone we have to find out. So fixed asset are these two numbers. Okay. So we'll start. So the answer will be in times. The next one is also working capital turnover ratio. So we can't say it is average, sorry, it is net only. Okay, we'll put it like this. I think that would be great. So we got our sales. What about the working capital? So the working capital is CA minus CL. So CA minus CL, I think we can get it from here. So we can copy this and we can get the answer. So first what we'll do, we'll get the working capital number. So working capital is CA minus CL. Okay, so let's set the working capital number. Working capital is 2400. So we'll go to the debt equity ratio. So in debt equity ratio, we have long-term debt divided by equity shareholders funds. So long-term debt, we have to find it out. So long-term debt is this, okay, debentures divided by equity shareholders funds are this amount. Okay, so we'll get the answer. So we got the answer. So it is to 1. And finally, we can find out the interest coverage ratio. So it is operating profit divided by finance or interest. So I think we'll take interest. First, we'll get the operating profit. Operating profit is 3200 divided by interest. So interest we have to search. So we have the interest here. So we got the answer for all these. So just to highlight them, we'll bold it. And we'll reduce the zero, sorry, after decimal. We'll just round it off. So that's about the answer here. See, we are not making any inference or any judgment about how the company has performed or anything like that. Okay, and the question has not asked for those things. So what we can do is we can end the question here. If you want, we can compare the answers. So operating profit should be 45.7. Okay, operating profit. I'm not sure whether these numbers are like perfect. Okay, I think it's not there. ROC at least 45.7. I think ROC is the 45.7. The other numbers are not like calculated. 1.92, 0.78, 1.92, 0.78 that we got. 4.1, 4.2. Okay, they have found out this as 4.1, I think. I'm not sure, like, so the answer is like perfect. So 12 is there, 12 is there. 4.2, I don't know like what they are meaning there. Okay, the meaning of it we couldn't decipher. 3.69, I think this is there, perfect. 0.094, I think that is this number. And interest coverage ratio, again it's not given. Okay, so certain numbers have been given. So either way, this is the answer. So this is how we have to approach a ratio analysis sum. So thank you guys for watching the video. We'll move on to the next sum also. Okay, we can do this sum as our next sum. Here the answers are like clear cutly given. They have been like clearly given. So